As we get into the fall months here in Central Texas, I want to encourage so many of you that are maybe 2 to 5 years out for retirement. When is the last time you did a financial reset? You really took a look at how things are going, the progress that you've made, and really more importantly, where you're going to land in the next 2 to 5 years. Is it going to hit your objective? Is it going to allow you to retire successfully? Today, I want to talk about your approach to a fall reset right here at the end of 2025. Good day, everybody. Chris Heerlein here of Reap Financial, host of Retire Ready TV on KXAN. That's News Channel 36 every week with you on KXAN, and host of Wealth Radio. That's every Saturday, 11 a.m. on News Radio KLBJ. Thanks for making this part of your week. If you enjoy our channel, I drop new content here all throughout the month. Be sure and hit the subscribe button, click the bell for notifications. So let me talk to you about how to do a fall reset when it comes to your financial planning. And it starts with having a look at your budget. When I talk about your budget, what I'm talking about is not just today, what's going out, but what will be going out, what you need to have to maintain your standard of living when you retire. So I'm talking today about a pre-retirement budget, maybe where you're at today, and post. And let's be clear about something. Most of you, while you're working, you're in your highest earning years. Many of you don't live on a budget, and that's okay. You know what you pay yourself first: 401ks, your IRAs, your brokerage accounts. You're putting money there. You pay your credit card off every month, but you really don't have an idea exactly what you need to maintain. That's okay as far as you're paying yourself first. However, as you're getting close to retirement, we want to make sure you understand what you need to maintain your standard of living. There's very few individuals that I speak with, consult with, that ever want to decrease their lifestyle. The conversation is, Chris, we want to maintain our lifestyle, maybe even increase our lifestyle. And so that's the approach right there. And if that's the direction you're going, you need to know how much you can spend confidently and how long your portfolio will last before you put those papers in walking into retirement. So again, having a clear idea of what you need today versus what you'll need tomorrow is a great start to success. As you're getting closer to retiring, that means the paycheck is likely going to begin tapering down or maybe stop altogether. So you need to review your withdrawal strategy and what kind of cash flow you can generate with your investments. When I talk about a withdrawal strategy, think about an income planning strategy. Ideally, how are you going to set up a paycheck from your portfolio? How much can your portfolio generate consistently, even when the market's up, even when the market's down, so that you can live on that portfolio confidently, not feeling like, well, we got to live leaner in down market years. We can go and sell the ship in higher market years. So these are the type of things I want you to really start thinking about when you're 12, 24 months out from retirement. These are critical pieces, because if you're spending too much, obviously that's an issue. But if you're spending too much of a certain account, that can also create an issue. It can create issues from the standpoint of you may be paying more taxes than you need to initially in retirement. You may be in a position where you don't have as many options in late retirement because you exhausted certain accounts too early. So it really, really matters how you coordinate all of your investments, all of your portfolio with your Social Security, any other income sources that you have. You may be in your late 50s, your 60s, and you may not even understand what a required minimum distribution is, but I need you to begin planning for your required minimum distributions. These are the things that kick in when you turn 73, or under today's law, even 75 for many of you now. And so this is a long ways out. And so you're thinking, I'm mid-60s, I really don't need to think about that. That's more than a decade away. You must begin planning for what your future required minimum distributions are going to be. And what an RMD is basically it's a requirement that you take money out of your pre-tax 401ks, your traditional IRAs, and beyond. If you have any dollars in pre-tax money, you're going to be forced to pull that money out, whether you need it or not, when you turn 73, 75 down the road. And for successful families, this can create a significant tax burden. It can create a significant snowball effect when it comes to paying more in Medicare premiums and a lot more, because your required minimum distribution is all based on your age and the size of the account, or multiple accounts for that matter. So you may be going, okay, my 401ks, my IRAs are worth X today. I can do some calculations on what the RMD would be, but no, we got to think about what your portfolio is going to be worth 7, 10 years from now when it's likely doubled. So the thing about RMD planning is this can catch a lot of even the most savvy retirees off guard because they haven't looked that far into it. We want you to prepare for what your tax liability is going to be in your 70s and 80s today. The only way to proactively do that is to be rearranging, maybe making some moves here in your 50s, 60s. That's where you're saving, how you're rearranging your assets. Maybe you're converting to Roth. Maybe you're saving in different types of accounts so that you have more control in retirement than any time in your life. Hey, as always, be sure and leave your questions in the comments section below. I'll try to get to those in upcoming weeks. So part of the financial fall reset may be looking at your financial gifts. I want you to do this at the end of the year in a tax-savvy way. You may be gifting to charities, you may be gifting to children, other heirs, that type of thing. I want you to understand what the tax implications could be on these things. We see a lot of families in their 70s, they give charitably, they take the required minimum distribution through the year, and then they give charitably, right? So they take the money out, they bank it, and then they cut the check to one or multiple charities. I want you to explore something called a qualified charitable distribution. If you're over 70, we believe that the most tax efficient dollars given should be from your IRAs, your 401ks first. These will allow you to give directly from it, satisfy some or all of your RMD up to a certain amount. And from there, that's shaving money, that's shaving income off the bottom line. It's better than a charitable deduction. So those of you over 70, be thinking about that. For those of you that give to children, understand that you can give up, to a certain amount each year, and you don't have to report it. It doesn't go against your lifetime exemption. But a lot of families feel like, I'm limited to these smaller amounts, be $18,000, $19,000 a year per kid, per person. But you need to understand that you're able to give more than that, depending on the type of money. Maybe it's bank cash, those type of things, dollars that you've already paid tax on. You may be able to give tens of thousands, hundreds of thousands of dollars a year away tax-free. But once you go over that exemption limit, you must report those with a 709 gift tax return. Just where I'm going with this is if you're planning on gifting to children or to anyone else, and you're wanting to make larger gifts, it can be available in a tax efficient way. You just want to, again, plan on where you're giving the gifts, where from, and how much. And the last tip as we plan for this fall reset is be looking at last minute tax strategies. You may want to put a few extra dollars in your 401k, your IRA, your SEP IRA end of the year. Those could be tax deductible. If you really want to get savvy, maybe put some money in your health savings account. That right there can be a great strategy for a tax deduction today, tax-free growth, tax-free distribution for qualified medical down the road. And then also keep in mind that under the law that passed this year, the One Big Beautiful Bill, the SALT tax exemption has gone up. And so that means you can deduct up to $40,000 on state and local taxes. So for those of you that have one or multiple homes where you're paying property tax, you may want to consider deferring paying tax here in 25, maybe wait to pay it in 26 and bundle up 2 years of tax payments in a single year. It didn't make sense before this law passed, but now that that limit's gone up to 40,000, we're seeing more and more successful retirees going to take advantage of maybe bundling up their tax payments and kind of stagger that year over year. So we started off this segment with the most important number. It's your budget. And I want you to email me right now, retire@reapfinancial.com. We're going to send you our copy of our customized personal budget worksheet. And this is the same budget worksheet we take all of our successful retirees through. I want you to get your hands on it at no cost to start this journey. Email me right now, retire@reapfinancial.com. I want you to click this next video to watch Secret Steps to a Happy Retirement.